A YouTuber and a well-known actor have been accused of pump and dump stock manipulation. So what is pump and dump stock manipulation? How to find one, and most importantly, how to avoid one. So in this video, we'll answer all these questions. Overview. Basically, when it comes to taking words of advice, be extra cautious with these two aspects. Number one, health advice, and number two, wealth advice. Fortunately, when it comes to health advice, not everybody can become a doctor. What I mean is, the industry is highly regulated. Even if you are a certified doctor, for you to give advice on health aspects, there are certain conditions or rules that you must follow. But when it comes to wealth advice, in the sense the financial advice, every influencer becomes a professional. And unfortunately, this industry is not well regulated, at least not until now. Probably that's the reason why financial experts are among the least trusted individuals as rated by general public. Usually, people don't trust their bankers, any sales personnel, and in this case, their financial advisors. That being said, hello everyone, I'm Rakshit Pai, and in this video, I'll assist you in avoiding a pump and dump scheme that's quite often noticed in stock market. What's a pump and dump? Pump and dump is a form of security fraud that basically involves inflating the price of stock based on false narrative. And then when enough money is made by the individual who perpetrated the fraud, the stock is dumped on the retail investors. So basically, spread false information to drive up the price of the stock and then sell all the holdings. This will cause the price of stock to drop sharply, causing thousands of retail investors to lose their money. Key qualities of a pump and dump. Sir Warren Buffett once said, it takes 20 years to build a reputation and just 5 minutes to ruin it. If you think about that, you'll do things differently. If any financial advisors or any individual for that matter care about their reputation, then the entire concept of pump and dump will become a history. But as with everything else, nothing is as strong as our greed or our fear. I mean, here greed for money makes even the most honest individual commit crime, especially if the rules and regulations are not strong. With that said, the key qualities of a pump and dump scheme are as follows. When you come across a stock for investing, see if you can answer these questions. Number one, the promoter, key managerial person, and their families hold the majority of the company's ownership, sometimes holding even above 75% directly or indirectly, and the FII, DI and retail participation is very low. And number two, stock price goes up for no real reason and will hit upper circuit for 2 to 3 consecutive trading sessions and so on. And number three, from a fundamental perspective, the company is considered a failed entity where the company revenue is low or declining because the management is not efficient. And number four, sudden news about the company's merger, acquisition, or news regarding the company having obtained a huge order book or such highly optimistic news, and such news is not verified or is left unverified for a long period. If answer to all or any of these questions is a yes and still the stock price is going up, then you, my friend, may be looking at a company that might be a pump and dump. How to avoid pump and dump? Seek answers to these questions and for sure you'll know when and how to avoid a pump and dump. Number one, who is buying? When we talk about pump and dump, there has to be someone who is pumping, right? So who is buying the stock? Who is that very interested individual who is making the stock price hit upper circuit every trading sessions? As per SEBI, under insider trading, the promoters, the directors and the key managerial persons and their families are considered insider individuals. And if they buy or sell company stock, then they must inform SEBI about it. You can check this information in the given link. So the next time an unknown company hits upper circuit for no apparent reasons, check this website. Number two, who is selling? Again, if someone is buying, someone else has to sell, right? The stock market is a buyers and sellers market, and in order to create a fake demand for a company stock, all you need to do is do more buy and sell transactions. So when someone is buying in lump sum, look who is selling. You can check the details in NSE and BSE websites. Number three, promoters are selling while retail investors are buying. I said this before and will say it again. Promoters will always know more about their company than you and I. They will know because they are the ones heading the company, isn't it? And if they decide to sell their stake in the company for reasons anything other than the basic 75% limit that's laid by the SEBI, if they are not interested in the company's shares, why are you flocking in to buy them? Don't take me wrong when I say this. Generally speaking, retail investors are unfortunately those who have the least amount of knowledge about a company because their access to company information is very limited, isn't it? In such a situation, if you, the retail investors, go ahead and invest in a company where those who know about the company a lot, that is, the promoters, are dumping its shares, then who is to blame? Number 4, everybody is buying. Again, I quote Sir Warren Buffett, where he says, "Be fearful when others are greedy and be greedy when others are fearful." Here, when we talk about a pump and dump, there will be a lot of optimism everywhere in the initial stage. People will quote 10x or 20x returns within a short span, or they'll say that the investment will become a multi-bagger or a short investment. Let me phrase this the other way. If someone says that it's a worthy investment, and if that someone is not a trusted source like a fund manager or an investment advisor, then why are you listening to it? I mean, when it comes to our savings, our money, shouldn't we be extra cautious? Is making money that big of an important wherein we are ready to lose it all? If that's the case, then be sure that you know the risk you're taking, because it's a case where you should be either make or lose it all. Then it's not an investment but a mere speculation. Number 5, avoid the unknowns. You won't see a pump and dump scheme in Reliance, HDFC or Tata's, right? Adani was a unique case where it was not necessarily a pump and dump, but for sure it had an unnatural pump in its share price. That aside, you won't see a pump and dump in well-established companies, but you'll surely see them in one location, one family, no business type, unknown companies, especially the small and micro cap companies, because they have nothing to lose when compared to the mid and large cap companies. Conclusion: there's no easy money in this business, and if you make easy money without knowing anything about investing, then you are luckier than Luffy from the One Piece. So the next time you plan to invest or trade based on somebody else's suggestion, think twice. See that the person giving the suggestion is a SEBI registered individual or a known informed individual. In any case, at least follow a strict asset allocation strategy wherein none of your investment gets more than 3 to 5% of the weightage. Be cautious, invest for long term, and stay safe. I hope the video was informative. Thank you for watching.